October 1929. The stock market is roaring. Fortunes are being made every day. But in a heartbeat, it all collapses. Millions lose everything. Panic spreads like wildfire. Yet one man isn't panicking. One man is calm. He's not scrambling to sell. He's not begging for a bailout. He's betting that the market will crash. His name is Joseph Kennedy. And what he did in the weeks leading up to the Great Depression would make him one of the few people to profit from the most devastating market collapse in modern history. This is the story of risk, insight, and foresight. How one man saw what everyone else ignored, and why most investors were doomed because they didn't. The 1922 seconds were a decade of euphoria. America had survived a war and was booming. Factories churned out cars, radios, and new inventions. The stock market wasn't just a place to invest, it was the place to get rich. Prices soared. Every day, more people bought stocks on margin, borrowing money to invest. It was easy, it was exciting, and it felt unstoppable. Banks, small investors, even ordinary workers were all caught in the frenzy. The common belief, the market could never fall. To think otherwise was almost un-American. Everyone was confident. Everyone felt safe. And that was the danger. Because when fear disappears, risk becomes invisible. And then there was Kennedy. Unlike most investors, he didn't buy into the hype. He studied the pattern, watched the margin debt grow, and noticed cracks forming beneath the glittering surface. While others were chasing short-term gains, Kennedy was thinking about what would happen if it all fell apart. He wasn't reckless. He wasn't lucky. He was observing, analyzing, and preparing. In a world drunk on optimism, Kennedy was sober, and that clarity would set him apart when everything went wrong. By 1929, the stock market was a house of cards. Prices were inflated far beyond reality. Margin debt had skyrocketed. Millions of investors were buying stocks with borrowed money, thinking prices would always go up. Joseph Kennedy saw the warning signs. He noticed banks and brokers were lending recklessly. He saw speculative mania in the ticker tape, and he understood one crucial truth: what goes up too fast can fall even faster. So, what did he do? He began short selling. That means he borrowed stocks from brokers, sold them at the current high price, and planned to buy them back later at a lower price, pocketing the difference. This wasn't gambling, it was calculated risk. Kennedy didn't just pick random stocks. He focused on companies that were over-leveraged, overpriced, or tied to speculative bubbles. Every move was informed by research, timing, and a clear understanding of human psychology. But short selling was controversial. Many saw it as betting against America itself, especially in a booming economy. Critics called it unpatriotic, greedy, even dangerous. But Kennedy didn't care about public opinion. He cared about reality. He also took practical steps to protect himself. He diversified his short positions, hedged against unexpected spikes, and moved cash into safer assets. When the market finally wavered, he wasn't just ready, he was positioned to capitalize massively. And then came the whispers on Wall Street. Stock prices were no longer reflecting true value. Rumors and fear began to ripple. Investors who had borrowed heavily started to sell to cover their loans. A small drop turned into panic, and Kennedy, he stayed calm. While ordinary investors were frantically trying to salvage paper profits, Kennedy was executing his plan. He was profiting from the collapse he had predicted, quietly, systematically, and legally. By the end of October, as the market plunged and the world panicked, Kennedy's foresight paid off. He had made millions at a time when countless Americans lost everything. October 1929 arrived, and the bubble finally burst. Stocks that had seemed unstoppable began to tumble. Panic spread faster than any rational analysis could keep up with. Brokers called in loans. Investors who had bought on margin were forced to sell, driving prices even lower. This was the beginning of the Great Crash, and the scene was catastrophic. Streets of Wall Street were packed with frantic men waving telegrams and letters. Banks were strained to the limit, and newspapers screamed headlines that fueled fear. The optimism of the roaring 20s evaporated overnight. Most investors were paralyzed by emotion. Those who had borrowed money were trapped. Their debt forced them to liquidate at massive losses. Ordinary Americans, caught in speculative mania, watched their life savings vanish. Meanwhile, Joseph Kennedy navigated the chaos with precision. Unlike the masses, he didn't panic. He had anticipated this. His short positions surged in value as stocks fell, and his careful hedges protected him from sudden spikes. Kennedy's calm in the eye of the storm contrasted sharply with the desperation around him. But it wasn't just about profit. Kennedy recognized a deeper truth. Markets are driven by human behavior, not logic. Greed and fear can inflate bubbles and then crush them. Those who ignore psychology, he believed, will always be caught off guard. The aftermath was brutal. Many investors lost everything. Banks failed, and the public lost faith in the market. Politicians began calling for regulations and investigations. The U.S. crisis. Economy teetered on the edge, setting the stage for the Great Depression. Kennedy, however, emerged stronger and wiser. His wealth grew, but more importantly, his reputation as a man who could read the market and human nature was cemented. He had not only managed risk, he had turned crisis into opportunity. The dust of October 1929 settled, but the lessons were just beginning. What Joseph Kennedy did during the crash wasn't just luck, it was strategy, preparation, and a profound understanding of human behavior. Kennedy saw the market not as a game of numbers, but as a mirror of human emotion. He recognized that greed inflates prices beyond logic, and fear collapses them just as fast. While most investors panicked, Kennedy had already hedged his positions, diversified, and kept liquidity ready. He didn't just preserve wealth, he exploited the chaos. But there's a subtlety many miss. Kennedy's approach was not reckless betting, it was measured risk management. He didn't try to predict every price swing or chase every trend. Instead, he studied patterns, watched sentiment, and acted decisively when the odds were clearly in his favor. This is what separates opportunists from gamblers. The crash itself also revealed a harsh truth about the system. Unregulated speculation can destroy fortunes overnight. Ordinary investors who lacked foresight and discipline were devastated. Kennedy's advantage wasn't magic, it was education, preparation, and a willingness to act differently than the crowd. After the crash, Kennedy didn't just walk away richer, he leveraged his reputation to build further influence in finance, politics, and beyond. He understood that risk is a tool, not a threat, and that those who master it can shape markets rather than be crushed by them. Kennedy's story also teaches that timing, preparation, and the courage to act against the prevailing sentiment can create extraordinary advantage. In a world that often rewards short-term thinking, he reminds us that vision, patience, and understanding systems deeply are the real edge. 1929. Crash didn't just reshape the stock market, it reshaped lives, economies, and the rules of finance. Millions suffered, yet one man turned calamity into triumph. Joseph Kennedy's story is a timeless lesson in risk, foresight, and human behavior. If there's one thing to remember, markets will always rise and fall, and emotions will always drive decisions. But those who study patterns, prepare, and remain disciplined, who understand the psychology behind the numbers, will always find a way to survive, and sometimes even thrive in the chaos. The next time the headlines scream, panic spreads, or fear grips investors, think of Kennedy. He didn't just manage risk, he mastered it, and in doing so became a legend in the art of turning uncertainty into opportunity.